Certainly. Below is an expanded summary of The Intelligent Investor by Benjamin Graham.
The Intelligent Investor is considered one of the most influential books on investing ever written. First published in 1949, its author, Benjamin Graham, is widely regarded as the father of value investing. This summary aims to dissect the key principles and insights presented in Graham's work, which have stood the test of time and continue to shape the philosophy of many successful investors.
Part 1, Chapters 1 to 8, Investment vs. Speculation.
Graham begins by drawing a clear distinction between investing and speculation. He defines investing as an activity that involves the purchase of securities with the intention of generating income or achieving capital appreciation over the long term. Speculation, on the other hand, is characterized by an emphasis on short-term price movements and market psychology, often with little regard for the underlying value of the assets being traded. Graham introduces the concept of Mr. Market, an allegorical figure representing the stock market's tendency to fluctuate irrationally. He likens Mr. Market to a manic depressive individual who offers to buy or sell stocks at various prices on a daily basis, sometimes irrationally overvaluing or undervaluing them. Graham advises investors to view Mr. Market's offers with skepticism and to focus on the underlying value of the assets they own. The author emphasizes the importance of conducting thorough analysis before making investment decisions. He suggests that investors approach the stock market as if they were buying shares in a business, considering factors such as earnings, dividends, and the company's competitive position. By adopting this mindset, investors can avoid being swayed by short-term market fluctuations and focus on the long-term fundamentals of their investments. Graham also introduces the concept of a margin of safety, which he defines as the difference between the price of a security and its intrinsic value. A margin of safety provides a cushion against unforeseen events or fluctuations in the market, reducing the risk of permanent capital loss. Graham advises investors to seek out opportunities where the market price of a security is significantly below its intrinsic value, thus providing a margin of safety.
Part 2, Chapters 9 to 19, Security Analysis.
In this section, Graham delves into the principles of security analysis, which forms the foundation of his investment philosophy. He distinguishes between two approaches to security analysis: the defensive and the enterprising. The defensive investor, as Graham describes, is one who seeks to minimize risk and preserve capital. This type of investor prefers to invest in conservative, well-established companies with a track record of stable earnings and dividends. Defensive investors typically prioritize capital preservation over aggressive growth, favoring investments such as blue-chip stocks and high-quality bonds. On the other hand, the enterprising investor is willing to take on additional risk in pursuit of higher returns. This type of investor may explore a broader range of opportunities, including undervalued or special situation stocks. Enterprising investors are willing to put in the effort required for thorough research and analysis, seeking out opportunities where the market price diverges significantly from the intrinsic value of the asset. Graham outlines various analytical tools and techniques that investors can use to assess the value of a security. These include earnings-based valuation metrics such as the price-earnings ratio (PE ratio), balance sheet analysis, and the use of financial ratios to evaluate a company's financial health. By conducting comprehensive security analysis, investors can identify opportunities that offer an attractive risk-reward profile and build a diversified portfolio of investments.
Part 3, Chapters 20 to 23, The Investor and Market Fluctuations.
In this section, Graham explores the psychological aspects of investing and the role of emotions in decision-making. He warns against the dangers of succumbing to greed or fear, which can lead investors to make irrational decisions and deviate from their long-term investment strategy. Graham introduces the concept of contrarian thinking, which involves going against the crowd and taking advantage of market inefficiencies. He argues that investors should be wary when markets are booming and valuations are high, as this often leads to unsustainable bubbles. Conversely, investors may find attractive buying opportunities during periods of pessimism or market downturns when prices are depressed and valuations are low. The author also cautions against excessive reliance on market forecasts or technical analysis, which he views as unreliable predictors of future market movements. Instead, Garham advocates for a rational, disciplined approach to investing based on thorough analysis and a long-term perspective. By focusing on the underlying value of their investments and ignoring short-term market noise, investors can avoid making impulsive decisions and achieve better long-term results.
Part 4, Chapters 24 to 34 Investment vs. Speculation results to be expected by the intelligent investor.
In this section, Garham examines the historical performance of different investment approaches and presents statistical evidence to support his arguments. He contrasts the results achieved by conservative, value-oriented investors with those of speculative or market timing strategies, highlighting the advantages of a disciplined, long-term approach to investing. Garham emphasizes the importance of a margin of safety in protecting investors from the inherent uncertainties of the market. He argues that by purchasing securities at prices significantly below their intrinsic value, investors can reduce the risk of permanent capital loss and increase the likelihood of achieving attractive returns over the long term. The author also discusses the concept of diversification and its role in managing risk within a portfolio. While diversification can help spread risk across different assets and industries, Garham warns against excessive diversification, which can dilute the potential returns of a portfolio. Instead, he advises investors to focus on a limited number of high-quality investments that offer attractive risk-reward profiles. Garham concludes this section by reiterating the importance of discipline, patience, and a long-term perspective in achieving investment success. He emphasizes that while the stock market may fluctuate in the short term, the underlying value of a well-chosen investment will ultimately prevail over time.
Part 5, Chapters 35 to 41, The Investor and His Advisors.
In the final section of the book, Garham offers practical advice on selecting investment advisors and managing one's financial affairs. He warns against conflicts of interest and advises investors to seek out advisors who prioritize their clients' interests above their own. Garham also discusses the importance of financial literacy and personal responsibility in investment decision-making. He encourages investors to educate themselves about the principles of value investing and to take an active role in managing their own finances. By developing a sound investment strategy and sticking to it through thick and thin, investors can increase their chances of achieving their financial goals over the long term. In summary, The Intelligent Investor by Benjamin Garham provides a comprehensive framework for successful investing based on timeless principles of value, discipline, and patience. By adopting Graham's philosophy and approach to investing, investors can navigate the complexities of the financial markets and build wealth over the long term.